It's an absolute pleasure to be here with Lewis Silkin. Obviously a very, very competent firm who, as very much mentioned, have been within this space for 2 to 3 years, as have we. So fairly good, competent partners, which I think is absolutely right to put that kind of risk warning at the start of any of these kind of events to obviously do your own due diligence on these types of partners and also early stage investments. Very, very quick introduction. My name is Hanley. I'm the Managing Director for TokenMarket UK. TokenMarket, we're in all of these various places, customary bragging slide. We've been around for 2 years or so, and we have a platform which helps early stage companies effectively raise finance via token offerings, whether those are regulated token offerings or security token offerings. Our background is we've raised just over £240 million for over 30 clients. We have a few lovely superstars who are doing very well, the likes of Stored, Civic, Fetch, who recently did very well last week as well, and a number of others. So just zooming out a little bit more, just to give a kind of a bit of an overview in terms of where the market is. We're actually seeing a lot of investment and money coming away from the public markets and actually moving into the private markets. Companies are staying private a lot longer, and we're actually seeing this huge amount coming in, huge big uptick over the last 2 years to this effect. We've seen companies like Dell, who have actually reversed off the public markets and gone private. We've seen people such as Elon Musk with various Twitter storms talk about how they'd love to go private, possibly under the influence. And we've, as I say, seen a number of these huge big tech behemoths who have stayed later and later stage and raised larger and larger private rounds. And this is how this is sort of panning out. So what we've also seen is, although there's more and more money going into the private stage funding of companies, is we're actually seeing much fewer deals. We're seeing them at a much later stage, so Series C, D and E, and at much higher values. So these kind of mega rounds or super rounds, 100 million, 200 million. We have the SoftBanks of the world coming in really large and late and keeping these companies private for a lot longer periods of time. We're still seeing more money coming into early stage as well, which is great, but we are seeing this trend for this later stage money coming into the market. So for early stage companies, raising seed, raising Series A, looking to develop their roadmap for the next sort of year to 2 years, we find that this capital raising is actually fundamentally a bit inefficient. It's a little bit outdated in terms of various other progressions we've seen in other markets. And I think these 3 things can be broken down into a limited investor pool. If you're going out, you're building out your projects, you're looking, you're pre-revenue, you're looking to gain capital to give you a roadmap for 18 months or what have you, it's really tough. You're building out a company, you're trying to build out a number of customers onto your platform, and if you're not well connected, if you're not part of that elite sect, it's very, very hard to go and raise that early stage capital to develop your ideas. There's certain hubs geographically where it's a lot easier than others. If you have gone through that route of working for Google, going and doing a startup, and then becoming a VC, you're part of that network, and that's a lot easier within these technological hubs where you have these large VCs who are happy to take these big risks on early stage companies. Same within China with AI as well, these huge big funds willing to take these big risks on these momentous types of occasions. And in Europe, we lag behind a little bit on this. We have maybe 5 unicorns, we have a couple of these guys who at these early stages really struggle to actually raise money in this sort of seed Series A type rounds. We have a huge company called Improbable in the UK, who their Series A was actually done by Andreessen Horowitz. They did a 20 million round, and they've been around all of the European VCs to try and raise funds, and they've now just done a huge private round last year for 500 million from SoftBank. So we have these opportunities, we have this wealth of very, very smart entrepreneurs and a very, very exciting technological and fintech industry within Europe. And sometimes it's very hard for these guys to be able to get access to that capital early on a more local stage. We also find that retail investors get a bit of a poor deal sometimes. If you were able to get into Facebook, it was probably at a very latter stage. They'd probably gone 1000x within various private rounds before you could actually get a piece of them on that public market. You might have been using them, you might have been following them for years, but being able to access and be able to invest in them at that earlier stage and be able to get the benefits of doing so very, very hard. Again, this elite set that kind of would trap you in there. Business Insider quote here, it's difficult, practically impossible for ordinary investors to access these types of investments for their own portfolios. You know, the really, really good deals, it is an elite set who are able to access them, and retail investors, whether that's lack of information, ability, access, very, very tough for them to get in at that earlier stage. And then this affects everyone, not only investors in terms of whether they're going to part with their money and go in on something at an early stage, but actually founders as well, is liquidity. We've seen these events grow a huge amount from going from that initial sort of seed to having a liquidity event, whether that's an acquisition or going to a public market to an IPO. It used to be maybe 3 to 4 years to be able to be listed on a public market. It's now almost 9. This is actually out of date. It's 8.7 years now. And getting tougher and tougher to do so. So not only does this make it harder for investors to gain liquidity, to be able to get out maybe after 2 to 3 years, to be able to cash in some of those earnings, it's really hard for founders, especially within technology companies, because one of the biggest assets they have at the start of a company is actually these superstars they mold who are the core of the company. So your CMO, your CTO, your CEO, guys who potentially for 9 years you are not paying market rate to. And then you have these behemoths such as Amazon, Google, Facebook, who are very happy to pay them 2-3 times the amount of money. And all you can really hold them onto is this chance of holding equity in that company and seeing that success afterwards. Now, giving those guys the chance to have liquidity is a really valuable tool in being able to actually keep them, stave off the vultures from taking your best staff away from you. So really, these 3 big things, we actually saw blockchain change the rules on over the last couple of years. So we saw in 2 years with this utility token space, over $18.6 billion invested 2017-18. We saw 1,500 ICOs, admittedly. Small subset of those who genuinely had something which was worthwhile and are building things out. A huge amount of a gold rush and a number of people not building a huge amount of things, cramming in the use of a token for something that it wasn't needed there. But nonetheless, a huge amount of new guys coming in and investing at an early stage in technology-driven companies. Over 30 million blockchain wallets actually created during that period of time, and effectively a new investor class that we started seeing in the market. We would see this from our own demographics, 20 to 40-year-old guys who've never rung up a broker before, never taken a stock from an AIM-listed company, who were really excited about being able to get direct access to founders, poke holes in their projects, get direct feedback, be able to get in at an early stage in view of supporting them at the start and being advocates at the start and being engaged with that project. As I say, we saw this ourselves with some of the flurry. So, we had a public-oriented sale last year where we had 126,000 people apply to come into a public element of a sale. We did KYC AML on over 50,000 people. We then whittled that down and we got that to 17,000 people who came through, contributed, and got distributed tokens in a matter of 3 hours. Now, that's an incredible event, a flurry of people wishing to get in at that early stage to back a company, but that's also showing what the rails can do, where you're able to actually process that large amount of people to come through and use blockchain technology to be able to do that. Absolutely tremendous to be able to do that. We saw this democratization in terms of access. So we had 153 countries come into our 31 sales over the last 2 years. So this dissemination of information where people could find and access this info, go in, look into the white papers, comment, have these communities built around these specific projects. A thing that we haven't really seen before. And then obviously we saw trading. We saw 24/7 liquidity, again, made possible by the blockchain. So markets that never sleep, no 9 to 5, no closing of markets, being able to go in, found a counterparty, trade, and have that within the blockchain. Really, really exciting things which happened over the last few years. And then we saw some quite interesting stuff in 2018 where we had this huge big peak, a lot of price-driven action, a lot of commentary around that. And then we saw this. We saw the US who came out, Jay Clayton, who said everything I've seen is effectively a security, gone back on this somewhat, now thinks Ethereum decentralized enough to be an actual utility, a few others potentially as well. Not the only thing I think that really sort of hit this market and sort of saw this sort of tail off in terms of investment. We saw some quite shady actions happen actually in 2018. We saw large amounts of capital taking advantage of that large amount of capital. So where initially everything was very, very transparent, everything being open on the blockchain, we saw some quite vulturous, advantageous deals at the early stage of some of these private rounds where people were taking 90, 95% discounts, having no lock-ins, having no intentions to support the company further on, but using their capital to get those very large discounts, and then as you get onto a public market, dumping very, very quickly. And this has really kind of affected this market. We've seen this sort of flatten out a little bit over the last couple of years. So we saw this term start being used more and more last year, where people said, well, actually, I'd quite like to get a piece of the company. I want some equity. I want some more regulation. It's going to be the year of the security token. We saw a number of ICOs who effectively did a Control F and then put STO into their white papers and then went out and looked to try and sell things. And then got some legal advice and got told you probably want to take a few more considerations on what you're doing. So I think we're at that point now in 2019, 2020. I think there's more competent information going out to the market. I think there's people who have a lot better sort of regulatory oversight in terms of what's needed to be able to formulate these types of offerings and how they'll progress over the next couple of years, which I personally think is going to be tremendously exciting. So what is a security token? It's quite simple actually. It's effectively a representation of a security on the blockchain. It's nothing new. It's something that's been sold for hundreds of years, and it can be a few different things. It can be equity within a company, so buying shares. It can be a debt offering, so where you go and issue a bond and you raise money that way and you pay back a fixed rate of return. It can be a coupon. But these are things which have been around for a number of different years and are effectively a wrapper put into the blockchain. So what we've also seen from a regulatory aspect is the markets were kind of caught out a little bit in terms of all of this money and companies staying private for a much more extended period of time. Now we've had, from the 20 million SMEs in Europe, we've really got 3,000 that have been able to be publicly listed for people to be able to trade those, which is a bit of an issue. You want these people to be a little bit more open, more transparent, because these larger companies, guys who are being able to report in a certain way, getting this transparency of information makes it easier for them to trade with each other. And we have certain companies who are absolutely beer moss who don't know how to trade with these incredibly well-funded large companies who have remained private. We've seen regulation in Europe in terms of allowing access to these earlier stage deals, especially within crowdfunding, where SMEs can now go out to self-accredited investors, not really retail, where you can go in, you can effectively say that, yes, I understand that my capital is at risk, I'm investing in this company, I'm not putting more than 10% of my net worth into this, and I'm very happy to go and proceed. And those limitations going up from 5 to 8 million last year. So just a quick word of warning as well. So although this is all well and good, and we're seeing all of these technological kind of advancements and pushing the envelope in terms of security tokens and being able to issue these on the blockchain and potentially moving to these markets where these things can be traded, new technology does not create liquidity. Markets create liquidity. So you can wrap something up in various different forms. If it's not interesting, if a large amount of people actually want to buy and to sell it and to trade it, it's not going to have liquidity. And we've probably seen a fair few companies maybe within the AIM listings market maybe suffer from this as well. You can reverse in, you can get things listed, but if you don't have that interest, if it's not exciting, it fundamentally probably won't work so well. So at TokenMarket, we're doing a few things. I think all of the technology aside, there's probably two core values that we have. We do a lot of vetting of really smart, highly scalable technology companies, which we think we would like to give access to a wider pool of investors at an earlier stage and allow them to come in, allow them to get the right kind of information in a regulatory manner to be able to go on and invest. So a few things that we're doing to that effect. In the UK, we're in the FCA cohort 4, where we're effectively able to look at a raise within the UK crowdfunding regulation, so to do a retail up to that 8 million. And that's something we're in the application of. Within Dubai, we've just had news literally this week. We've been accepted to have a dealer broker license, so we can go out with private offerings, and we have certain exemptions where we're able to go out and obviously promote those dealings over there. And in Malta, we actually are under a grandfathered agreement within the VFA where we have a decentralized application exchange. And this is something that we'll look to trigger a multi-trading facility license by the end of the year. So looking to have this end-to-end ability to be able to do issuance and then go through and look to exchange as well. So this is really the end-to-end, and where we really see what we can do and how we can help companies is to ensure that the value of investment actually gets transmitted to the companies, which then actually gives better protection and also more value to people who are coming into those companies. If we're able to do the issuance, to be able to hold the KYC, the management, update cap tables in a less overbearing physical manner in view of actually having liquidity on exchange at an earlier event with less intermediary costs and less legal costs as well, which typically, if you're taking a company public, can be anywhere from $350,000 to $4 million. We think that's only a good thing for the initial investor, because more money goes into the company and helping them actually develop their project out and hit their goals. So what's next? I think there's some really various interesting things going on in the space. The implication of things like stable coins, if people are looking to do security token offerings, let's say people doing large bond offerings or REITs or what have you, being able to pay dividends potentially in a stable coin. So rather than having to do transmission via bank accounts, having an automation in a wallet where you're able to pay out on, say, a quarterly basis without all of the various processes and people needed in that transaction, do that in an automated way. We're seeing some big plays from various exchanges to do security token markets. We obviously have an interest ourselves. We see people like T0 in the US. We see the Malta Stock Exchange, very, very bullish in facilitating this market. We also see the SIX exchange as well within Switzerland. We're seeing a lot of development in that space. I think there's a huge amount of legal hurdles. There's a lot of regulators that need to come on board and a huge amount of explanation that needs to still happen. But there's a number of companies who are really pushing on that side. So I think that's a good time to sort of bring up the panel really and maybe go into it a little bit more from maybe a bit of a different perspective from mine. So if I can invite you guys up, that'd be great. I'm terrible at doing introductions because I make awful jokes. So maybe if I can go left to right, if you'd like to introduce yourselves, give you a minute time limit or so. Nothing too inflammatory. Yeah, go on Irfon. I'll start you off.
Yeah. Hi, my name is Irfon Watkins. I'm the CEO and founder of a company called Dovu. What we do at Dovu is we created a token that you earn by sharing data specifically in the mobility space. So we're targeting the mobility area. So mobility means moving really anything from A to B. So a little bit about us, we, from a funding perspective, we got seed investment from Jaguar Land Rover to start our business up, so they're equity holders of the business. We then did an ICO token sale with TokenMarket, who are strategic partners there back in sort of 2000 and whenever it was, 17, 18. And now we're doing an STO with them, sort of probably in April. So and I can talk about why we've sort of done that in a sort of bit more detail. Our customers include Jaguar, BMW, Renault, Nissan, Mitsubishi. We just signed a deal with Go Ahead here in London for Thameslink. Bad day to announce that. But also things like Gatwick Express and sort of buses, and Volvo trucks as well. We work with to name but a few. So built a product, building the real business, and leveraging this new funding sort of process to assist us upon our way.
My name's Townsend, Lansing. I've got about 20 years of experience in traditional financial markets, having started off as a U.S. securities lawyer doing DCM, ECM, capital formation, fund formation, and then the last 15 I've spent building financial products, from structured products all the way into ETFs and other exchange-traded products. Currently kind of an independent consultant, writer on a wide variety of things, but including the intersection of the digital assets world and the traditional financial services.
So hi, I'm David Willbe, and I'm a partner here at Silkin and co-head of the tech practice. I've been working on fundraisings for tech companies for about 15 years, the whole gamut from sort of seed and very early round funding through venture capital, all the way through to private equity, public markets and disposals, acquisitions, sales. So naturally we got involved in the ICO wave. We managed to surf that without falling off too many times. And now we're working with a number of companies on STOs as well.
Fantastic. So yeah, really varied panel who've obviously sort of been through the funding route probably a few times, have the battle scars and what have you. One question I wanted to just sort of kick off is just look at the landscape really in the UK at the moment. So we saw just over 5.96 billion invested in 2018 to UK startups, or sorry, within Europe, 33% of that actually within the UK. So tremendous sort of share that actually came in. That was obviously 2018. So do you still think the UK is still that place to look for early stage funding as we sort of progress into a maybe more uncertain world in 2019? And do you think these VCs are potentially the guys to go out to at the earlier stages? I'll let you go first, Irfon.
I mean, the VC is broken. The model's broken. VCs don't take risk, and absolutely not. They're not the people that you go out to in the early stage. I think the angel model in the UK is very good. I think that the tax benefits are still there, and I think there's plenty of cash there. So I think if you've got a good idea, it's not that difficult to raise money, frankly, if you've got the team and you're able to execute. I still think on the other side of it, diversity around investment, whether that's ethnicity, whether that's gender, is just atrocious in the UK. I don't know if it's any better anywhere else. It's sort of absolutely crazy, and that's why I think having models that sort of changes the sort of investment structure to allow retail to get involved, I think is really exciting, and I'm sort of a big fan of that. But frankly, I don't think access to cash is for a middle-aged white guy who sort of built a couple of companies before is that difficult.
Very honest, yeah.
Yeah, I mean, the tax schemes at the very, very earliest stage have been immensely helpful. I think whatever your political persuasion, you have to say over the past few years, well, a little longer than a few, but the SEIS scheme in particular has really boosted the ability of people to get that very earliest funding. I think the challenge in the UK has moved on. We're seeing a lot more companies come through now than we did 10 years ago, come through those very early stages. But the challenge now is that next round. And one of the things that we talk to our clients about is, yes, there's a lot of people out there who are, they're very wealthy individuals. They've been to see their financial advisor. Their financial advisor has said, have you done your pension? Yeah. Have you done your ISA? Yeah. Have you done your SEIS investment? And they go out and they look for something to put their SEIS investment into. That's easy money. Is that good money? And there is there's an argument that it's good money if it's money you can get, right? But there's also an argument, I think, that when it comes to that next stage, going round to the venture capital, being able to point to a name, having an investor who's got some connections, who's been there before, who's giving you some strategic advice, as opposed to just writing you a very nice, cheap, easy, low-effort check, is actually a really beneficial thing. So, it can take a bit longer, it can be a bit harder. The professional investors, if we want to use that term, do drive a harder bargain. But the low-hanging fruit is not always the best.
No, I think the UK is going to remain probably the center point for most early stage into VC investing. I mean, probably a few other challenger markets like Germany, Berlin. It's quite disparately spread out across the country. I think from the rest of the EU, there's probably very little challenge. I think it's going to remain the same, given the amount of money and the desire of a lot of the insto professional investors to remain in London.
I'm with you on that. I mean, Berlin has a terrible airport. Paris, I lived there for 3 years and I used to have to top up my monthly travel card, which was digital, on one day of the month. So yeah, that for me was a reflection of how things might be starting up a business there and going to get funding. So what I talked about a fair amount is this wide pool of investors at an earlier stage. And we've seen crowdfunding in certain sort of aspects be very successful doing that. People such as Monzo, I think Brewdog have like 84,000 people on their cap table now that they have to manage. But then we sort of see the other end as well, which is maybe a bit more of that SEI, SEIS money that goes in, and a couple 100,000 or what have you, more lifestyle orientated business. I mean, how valuable do you see that, having a wider base of investors? Is it critical? Is there a certain type of company you think that would be more beneficial for than potentially others?
Well, for us, we're doing an STO and we did a token sale because we're a B2B2C company. Part of our ecosystem, we're building an ecosystem. Part of that ecosystem is having customers and users globally. I love the idea that our customers can actually take a little piece of us early on, can own a little bit, subject to all the sort of conditions. I think but also we've done the other bits. So we've got strategic investment from Jaguar Land Rover, and the other reason we're doing the STO and doing this round is that our customers, and I've mentioned a few of them, also want some skin in the game. They want to take some equity as well. So we've got an element of marketing. So for us, it's perfect. We've got wallets that get distributed, and people can sort of buy a little bit of us. And then part of our ecosystem is reliant upon these big mobility partners that can actually help us to achieve scale. So I think having this sort of hybrid where you can tokenize equity, offer it out to the retail market, as well as offering out in a sort of institutional round, I think it's really exciting. So I think it's important for us. It's part of our market, part of our product and marketing strategy.
So just playing sort of devil's advocate, one of the things we sometimes hear from some sort of VCs, I'm going to direct it at you, Townsend. I know you're not VC, but I'm going to direct it at you anyway. Just
sure.
You're the VC.
A bit of friction in the panel if possible. We hear certain VCs will come into a later round, and if someone's gone through a crowdfunding process, we often hear your cap table's a mess. That's a bit of a nightmare. That's going to make it tough for us to come in. Do you think that's a valid concern? Or?
I mean, I think it is from the VC's perspective. I think, obviously, as was said earlier, the VCs, when they come in, and this is something that, they have a lot of expectations in terms of preferential rights. They have a lot of expectations in terms of contractual rights around shareholders agreements, and dilution mechanisms, ratchet provisions, drag and tag, and all these things that obviously a complicated cap table makes that more difficult for them to implement. So I think nevertheless, I think crowdfunding has a very keen place. If you think the VC market is very difficult to access, the angel market and early stage pre-revenue companies is even more difficult. In fact, nigh impossible. I think in a lot of ways, you're right, you can't find funding, but if you're an early stage company founder, I know a few of them, they much prefer to be working on the business than running around trying to attract funding from random angel investors. And I think crowdfunding allows that disruption there. Where it intersects in the next stage when you get from friends and family to seed to Series A is still very much up in the air, because it's true that the professional money has certain expectations, and if you show up with a cap table of 84,000 small investors, they're going to look twice. Obviously, if the investment's good enough, I assume they'll invest, but they're going to look twice at that.
Yeah, I think that's maybe what it comes down to, right? If the investment is good enough.
Yeah, I mean, people would have bought Facebook even if it had 1 million retail investors. But I think it's a double-edged sword. I think crowdfunding does a fantastic job of making it much easier for someone just to standardize that early stage funding, right? And I think that's a fantastic thing for companies that want to just operate, as opposed to fly around the world talking to private family offices and wealthy individuals.
Yeah. Sorry, I know, but as an entrepreneur, my job is not to make it easy for a VC. My job is to build a business, and statistically, post VC funding, most CEOs get fired, within 18 months. Okay, so and this VC model that sort of gets forced down your throat. It's sort of what I need to do is I need to get some seed money, I need to do an A round, I need to get a VC involved. It's probably wrong for, I reckon, about 70% of companies that go down that path. And this STO model is a different way of doing things, and it's a way that an entrepreneur needs to be grown up about having the end in mind. And the end in mind sometimes isn't, be careful what you wish for. You get that VC involved, they structure a deal, and it doesn't always end up the way you want it to do.
Yeah, so, I'm sure that's right. I mean, we're maybe being a little bit too quick to bury VC. The list of billion-dollar tech companies that never took a VC check is not a long one. And there's a reason for that, you know. I mean, ultimately, when you need that money because you don't have the tills ringing and you need to get from A to B, there's somebody willing to write you a check. And yes, it comes with strings attached. Absolutely it does. They want to see their return. They want to see the business run in a certain way. And I 100% agree it's not the right model for everybody. And you know, you've got to consider how that works, because this sort of grow really huge off the back of VC money and then sell very quickly, maybe without necessarily having figured out how to monetize your product, not mentioning any social networks in particular, is, you know, it's not going to work for everybody. That user acquisition play is not necessarily the way that you should be doing it. But for those it works for, it works, and it's a, you know, it's a well-trodden path. I actually think that the crowdfunding platforms could do more to help with this issue, the equity crowdfunding platforms, to help with this issue of presenting a cap table. So I thought the Seedrs model, where they packaged all of the crowd into one vehicle, I think that has a lot to be said for it, because you don't get 100 names on your cap table. And there are other ways that you can do it too, non-voting share classes, different rights, all of those sorts of things. They are not yet, in my view, standardized across the equity crowdfunding piece. And so VCs are still seeing more different structures from companies that have been through that journey than maybe is ideal. And if that could settle down a little bit, I think that would be very helpful. Or maybe we just take it out entirely.
Yeah, I don't think we're there quite yet, as much as some people might see. I mean, do you see as in this kind of changing landscape, because we saw especially 2017, which was a ridiculous time in space, to be perfectly honest. We saw out of the US some of these utility token companies raise more money than VCs were putting in a couple of those quarters. Do you think during that time they maybe took a bit of a reassessment in terms of how they were operating? I mean, I absolutely take your point on, you know, some of these guys incredibly well connected, absolutely fantastic networks. You know, if you get a Sequoia on board, you get an Anderson Horowitz, you're a tech company, you're going to fly regardless. You know, you get that name, that gives you a springboard into a fantastic environment. I would counter that. How many, in terms of a percentage-wise of VCs, could be seen of that kind of springboard and adding that kind of value, though? So for those guys who maybe aren't those, let's say, let's be nice, tier one VCs, do you think they're looking at potentially other models in terms of how they look at crowdfunding, or they look at other alternative ways for that kind of initial investment stage? Or do you think they're very happy to just keep on doing what they're doing and everything will be all right in the end, this all sort of stuff will blow over?
Without speaking for the whole industry, I don't think they're necessarily, and you probably, overly concerned about disruption in their space. I think they look at crowdfunding and as much more kind of an early stage pre-revenue seed opportunity. I think they tend to have different metrics. Most, even the smaller VCs, obviously, you know, Sequoia, not the Sequoias, not the Excels, they still have metrics around what they're investing in. They're still bringing institutional funds to the table, and I don't think they're, from what I understand, necessarily as worried about it as it stands now, mainly because the regulatory position also limits the amount you can raise. I mean, these guys write much larger checks, especially as you get into later rounds. But I think it's something that is probably on their radar over time as to where it's going and how, in particular around how these early stage investors who get in and are going to be something the VC has to reckon with in a later stage is probably something that they're very, very keen on. Because it is, as you said, very difficult to manage a cap table that large when you're a VC and you want to come in and be like, I own everything, I control everything, I'm going to dilute everyone. Not that they do that, but.
Yeah, well, I think that, you know, there's a whole, you know, when you talk about a business being successful and these billion-dollar businesses, you know, I'm looking at it as a founder. Okay, so that there's two separate things. The business might be doing $1 billion and might be fantastic for the shareholders. For the founders, they may not have had such a great experience. So you know, so FanDuel is a good example of that. If anybody's sort of followed that, it's a perfect example of a unicorn, you know, that exited and the founders got nothing, you know, and they'd sort of raised $300 million, and it's a disaster story. So as a sort of an entrepreneur, so you know, when I go back to, it's not my job as an entrepreneur to make it good for the VC. My job is to build a business, and frankly, if the business is good enough and exciting enough, and it's got the right traction, okay, they'll find a way of financially engineering the model to make it good for them to invest, you know. And I think what this type of investing does, the STO aspect does, it just gives another option to help get there. You know, you've got to help get there. There's no, VCs don't invest in risk. There's no risk investment in, you know, everything's growth. Everything's growth, you know, and so this gives, I think, an option to sort of another option to get to the point where you can, you know, sort of do the Reid Hoffman sort of blitz scaling and whatever else that you want to sort of, whatever else that you want to do. And as an entrepreneur, you make a choice then whether you go down that path and do a deal with the devil to blitz scale and go for it, you know, or whether you don't, you know. But this, I think, is that's how I would look at it as an entrepreneur.
Again, I think, I mean, anyone ever really wants to know what it's like, technology at VCs, just watch Silicon Valley. I think it's remarkably accurate from my experience in representing both sides. I think there's no doubt about it. I think where crowdfunding probably steps in is it allow, because I mean, a lot of what the trend now is towards bootstrapping, right? And crowdfunding is another way of bootstrapping, in my opinion. In other words, it's not, because a lot of angel investors bring many of the, or similar requirements to a VC, right? Especially the wealthier family offices and private individuals. They show up with law firms and they show up with shareholders agreements and contracts, and you know, at that point when you're pre-revenue earning, I think if I were an entrepreneur, I'd rather raise money through crowdfunding than agree with a wealthy individual all the same rights of the VC without bringing the brand name.
Yeah, no, absolutely, and you know, I think one of the areas that potentially crowdfunding and, you know, getting that wide base at an earlier stage is these kind of outliers as well, right? So these VCs will have very standardized thesis in terms of what they want to go into, what they've seen being successful, you know, huge amount of data coming into that world, but sometimes the most successful companies are the ones which really explode, are the ones that no one sees until they've crept up and absolutely exploded, and potentially getting the kind of the masses to go into those to start with can help validate.
What's the return on a VC? It's something like less than 2% as an average return to the sort of funds that I read the other day. That's pretty poor.
I don't know. I'd have to.
Unverified, and not going to quote it because
Yeah.
I have no idea. But I've heard that only 20% of VCs are actually successful. Who are out there, and then there's a huge weighting to you know, some of the top tier in terms of how they.
But public markets investors are even lower.
Oh, absolutely,
right?
yeah, no,
And
completely,
crowdfunding
completely.
even lower than that.
There's a reason large institutions, the very smart people, give their money to VCs.
Yeah.
Let's be clear. I think I wouldn't want to be like. By and large, those guys, they and the private equity houses do very well ultimately for their investors. There are, of course, I mean, markets are getting tighter in both VC and private equity space, so it is becoming more challenging to eke out value, no doubt about it.
Okay.
I think one of the interesting things that we're probably not talking as much about is how it works from the other side. So we're talking about sort of investors coming in at various points. One of the things that you can be sure about is that when a professional investor, venture fund, seed fund, whoever it is, whatever stage we're talking about here, goes and looks at a company, there's some rigor applied to that. And yes, there are absolutely issues around diversity, there are absolutely issues around you not fitting into a particular box, and they're going to discard some people for bad reasons. Actually, they're going to discard some people or give some pretty punchy feedback for good reasons, because the business is not being run very well and it could be done differently. And for me, one of my hesitations about large-scale crowdfunding, you know, look at the ICO market in 2017. I know that wasn't crowdfunding per se, but you know, that rigor just wasn't there. People were jumping into anything with a nice sizzle reel, and it was raising millions. And you know, a lot of those went nowhere, and that's fine. I'm almost worried what would have happened if they carried on, because where is the analysis of their business model? Where is the the actual diligence and checking that everything's okay? Nobody did that for any of these businesses, and you know, that potentially is a worry, I think.
TokenMarket, we
Yeah.
a little bit of that. Yeah, but
Right.
anyway.
This is one of the things that, I mean, disruption and disintermediation are fantastic elements, right? And I talk a lot about this, and we spoke of this in the last panel. Like, the reality is, intermediation in financial services does have value. I mean, often it's mispriced, and I agree, often it's too expensive. But there are intermediation participants who are actually adding a lot of value, in particular around the things. You know, if someone goes to an IPO, they've got underwriters and an issuer and two sets of lawyers, and they're doing work that is actually winnowing down information. You've got standardization of disclosure. And these are a lot of things I expect places like TokenMarket to bring along. You've got, you know, liquidity makers and research providers who are writing on the equity and so on. I think a lot of that is still missing in the crowdfunding space. And I agree with you. And as you know, I look at crowdfunding, and I kind of sometimes have to really have long conversations with the founders to be like, what are you doing? I think it's something that will come eventually, but it's something I agree with you that ultimately you need some level of intermediation around trust and reputation and risk, such that ordinary investors can actually be confident in what they're buying.
I'm going to throw it out there, you know. So I don't know if you followed the story of Aston Martin's float and the 163 million that was given to the banks, and how the retail investor got screwed and the pension funds got screwed and the price dropped. You know, so from that aspect of it, I don't think that was a great story, and I think that the retail investor, but that's a sort of separate thing. But I think the fraud is fraud, and that ICO thing, fraud happened when the railroads sort of kicked off. It happened when cars got invented by Henry Ford. It happened in the dot-com time. Fraud is fraud, and regulators have to sort of catch up with it. For us, working with TokenMarket, we had Jaguar Land Rover as a shareholder. We had KPMG on our white paper. It's a new mechanism of fundraising, absolutely in a certain way. But frankly, you just have to go about it. If you've got your personal reputation, your morals to deal with, you go about it in a professional way. And if somebody, however, in our white paper, 40% of people didn't read our white paper who got involved. So it was a crazy time, but I don't buy in. The Big Short is a good example of failure in regulatory sort of infrastructure. Aston Martin's a good one, and you can look at a few other things.
Enron's a classic.
Enron's a classic one,
public markets are not 100% efficient, and nor are they. Again, I think if you took, I guess what I'll say is, look at it as a percentage of total capital formed, right? Yeah. It's a very small percentage in the public markets that are fraud. If we go back to the ICOs, unfortunately that number, I think that ratio would be scarily high. And I think, look, Enron is a classic example. I mean, it was a public company in the most regulated first world market in the world, and they still managed to commit fraud. Where I come from is there's going to be a marrying of traditional financial services and the intermediation that someone like David does, or the underwriters do, and crowdfunding STOs. And that's going to happen. And the question is, what is the right level for it? I think the idea that, kind of crypto anarchically say there should be no intermediation at all, it's not a good choice for investors, in my opinion. That's kind of where I often write about.
100% agree. 100% agree. And I'm not saying this because TokenMarket are here, but TokenMarket, their model was based on results. They choose their partners carefully, and the companies they work with carefully. And that's why we work with them. And and it's absolutely about how you do need to have the ability to approach the market professionally, and you judge the company by the company it keeps. And I think that's absolutely important.
It's one of those areas where we see that gap for going that kind of route of VC, where you'll have typically a lead investor who will go in and they'll do all of that due diligence, and they'll really kick the tires. They'll take a period of maybe 8 to 18 months in some cases before they go in, and then others will follow on. And sometimes in crowdfunding and with ICOs as well, it's the same thing. They only have to submit a certain amount of information, and certain things such as cap tables and what have you aren't disclosed, and that's where we really see that gap being disintermediated somewhat. If you can bring in layers to be able to better disseminate that information at an earlier stage and then bring that out, then that can potentially be quite interesting.
And it sounds like tough on VCs. And our seed investment came from Jaguar Land Rover's VC fund. So we did that to start with before we even went down the ICO path. And that's a whole other story. How do you bring Jaguar Land Rover along a journey where you do a token sale? That's for another time.
Very good. So we talked loads about the initial starting of funding and what have you. And one of the facts we saw brought up in the presentation was that there's 20 million SMEs in the whole of Europe and 3,000 which are available on public markets. Should there be more? Should there be more companies who are available on public markets? Should there be smaller caps coming into play? What are some of the pitfalls or advantages of that coming about, potentially fueled by some blockchain technology?
So I'm not a go into court and stand there and argue lawyer, but we all get this training. And the first thing we're told is don't ask a question that you don't know the answer to. I'm about to disobey that, and I apologise to everybody that ever taught me. So my concern about public companies is always the disclosure. So the big difference between doing a private raise, a private crowdfunding equity is, and then something where you have trading, regular trading, liquidity, is with those sort of one-off events, you present your information and it's a snapshot of how the company looks at the time. And whoever it is that's making a decision as to whether or not they're putting their money in has that information. And some platforms do that information or insist that that information is done better than others. I think we've all agreed on that. But broadly speaking, that information is there, and anybody who's going to risk their capital has it available if they choose to read it. Sometimes, unfortunately, they don't, but that's up to them. Where you have currently in the equity capital markets the ability to go and buy and sell, albeit within business hours and all of those sorts of things, there are certain obligations on those companies to keep the market up to date. Where there is disclosure, where there is a new event, where something happens, effectively the rules say that the market ought to know about, then you ought to tell the market. That's pretty much what it boils down to. And there are rules of varying depth and complexity depending on what market you're listed on. My big chill when I hear 24/7 electronic trading, you can see where I'm going with this, and I don't know the answer to this question, is what are you imposing on these 20 million SMEs to ensure that when I wake up at 4 in the morning with a hankering to buy me some tokens, I can make that decision in an educated fashion? That's my big concern about the whole thing. That might not be there at this point in time, but that I think is what that market is going to need in order to get those 20 million. Clearly it'll never be 20 million, but get a much greater proportion of those SMEs publicly traded, is some reassurance to me that, the fact that I missed the STO and I'm coming in 6 months later doesn't put me at a disadvantage. I can still see all the information that I need to make an educated decision.
Yeah, I think traditional public markets, the answer is probably no, right? Because they're kind of like a roach motel. I mean, it's very difficult. It's very easy to list, in particular in the U.S. We used to say this to a lot of clients when I was a lawyer, and back like 15 years ago. It's very easy to list in the U.S., very difficult to delist. And once you list, you've got a lot of ongoing obligations. And it's a lot of question of, and you mentioned kind of a lot of companies staying private. That's not because of the actual cost of listing. That's because the short-termism around analysts and investor expectations on a quarterly basis. And there's a lot of companies who would do very well to stay away from that, right? And so then again, the private space, where I'd like a bit more disclosure, to be honest, on even in crowdfunding, but I agree it doesn't have to be to the level of what you get if you are actually an active listed on the LSE or other main markets.
We've also seen company life cycles completely reduce into these much smaller time frames. You used to have these certain companies that would go for 100, 150 years. You just don't have that anymore.
Yeah, I mean, there are studies that, family-run companies owned by, like Bechtel and the like, consistently outperform, similar-sized companies that actually have to publicly list, mainly because the pressure on the managers to show short-term results can be detrimental.
So I think that's a perfect time to say, go grab a drink, delve into those various subjects, argue them amongst yourselves, and just want to say thank you very much to the panelists for turning up and giving some really good insight. Thank you.